All right, folks, welcome to the session here. It's Rodrigo. Let me know if the mic is working, just doing a quick mic check. We're going to be starting here in about 7-8 minutes with Matt Maley, Chief Market Strategist at Miller Tabak, 40 years in Wall Street. We will be covering a bunch of stuff. We'll get into it later. Mic is good. Perfect. All right, folks, make sure pen and paper. Today we have a packed session. So we'll see you guys here in a few minutes. All right, everybody, welcome to the session. Heather, good to see you. Blaze Boy in the house. Let's go, folks. We have a packed session. Welcome, everybody. My name's Rodrigo. Thanks a lot for being here, folks. We do have a few people that are trickling in. Couple shout outs. Anson, we got one person connected by phone. Shout out to you, man. Brandon, Brian, Casey, Godala. All right, folks. It's a packed session. We got a couple hundred people in here. Are we ready? Okay. So let me know in the chat when you guys are good to go. Matt Maley is going to be here with us today, Chief Market Strategist at Miller Tabak, 40 years in Wall Street. He's been around. Many of you guys have already seen him maybe on Bloomberg TV or CNBC or Yahoo Finance. He's all out there. And we will be talking about trade ideas, education, Matt's strategy, right? The Matt Maley strategy, his 40-year strategy, right? Sector scoping, options education, setups. We will be talking a little bit about Bitcoin, commodities, buy, sells, charts, education, of course, market discussions. And by the end of this session, I promise you, you will have a much, much better understanding of the current market environment. And if you do want to trade with Matt, you can always join his room. So make sure to stick around till the end, folks. We will be giving you a live Q&A. I'm sorry, a live view. We're going to show you the chat room with Matt, what the trades are. We're going to have a Q&A if anybody has questions. Typically, we would do this live, but since COVID, we've been doing it virtual and it works out better for everybody. So I think we do have Matt Maley in the house. So let's give him a proper introduction. Matt Maley. All right, I think we have Matt there on the back. Let's bring him on.
There we go. Hey, Rodrigo, how are you?
Hey, Matt, how's everything going there? You're good with the computer and everything? You have no issues?
Yeah, you're all set. Can you see me and hear me and everything?
Yeah. All right, everything's good, man. So how you been, Matt? How's everything going there in the live room?
Well, I got to tell you, it's a lot warmer today. We're not in the live room, obviously, this weekend, but I woke up yesterday morning, minus 9 degrees outside, and that was without the wind chill. So it was anybody who lives in the Northeast here in the U.S., they know what's going on. That was a tough day. Thankfully, it was real quick, but things have been red hot in the chat room. We've been very, very active, needless to say, with what's been going on in the marketplace with this big rally we've seen at the end of, it started at the beginning of this year. And then, of course, we had a big surprising employment number on Friday that got the market to dump a little bit. And I say dump, that's too strong of a word. It's just a pullback for one day. We'll see what happens. My kind of feeling is, well, we'll have to see what happens in the morning. I do think the market is getting a little stretched here on a short-term basis, so we'll see what happens. But we got a lot of things going on, and I guess the most important thing I think for people to know right now is that no matter which direction the market's going, it never goes in a straight line. We've had a lot of reasons for the market to probably should have pulled back this year. Some earnings haven't been all as good, haven't been very good at all. But companies have been able to look past that, or investors have been able to look past that. But the market, as much as it had rallied in January, hadn't become overbought, and it has become overbought now. So we're probably going to see a little bit more volatility, some more ups and downs along here, and we've been able to capture that with some of this shorter term trading in the chat room. So it's worked out real well. We're looking forward to more excitement in the days and weeks to come.
Right, that's good. So we do have, all right, so we have some people here popped in. So if this is your first time in any of these sessions, put a 1 in the chat. If you've been here before, or if you're regular, just put a 2. That way we know more or less how to carry on the conversation. And we will be doing a couple polls there to kind of get to know the audience. All right, so the 1s are coming in like crazy. Nico, Carr, Sam. All right, so we do have a lot to discuss here, Matt, right? What are a couple of things that you have been looking in the markets? Some interesting, I mean, you're an analyst, chief market strategist at Miller Tabak, but so for all the people here that are just watching for the first time, which is a lot of them, can you give us a brief background introduction for those that are not familiar with you?
Yeah, I mean, the one thing that I do with it, I think it's a lot different than most other strategists on Wall Street is that I'm a former trader. Spent 25 years trading on Wall Street on the institutional desk at Solomon Brothers for 15 years, and then 10 years at Merrill Lynch. Now, for those who are a little bit younger, don't remember Solomon Brothers. It was the most powerful trading desk on Wall Street for several decades. I was there for 15 years, not in the 70s, 80s, and 90s. I wasn't there in the 70s, but I was there in the 80s and 90s for 15 years. And then I joined Merrill Lynch, and I talked to the trading desk of some of the biggest institutions in the business, the biggest mutual fund in the business, the Fidelity, the biggest hedge fund in the business, BlackRock, also big mutual fund, other big mutual funds, but also insurance companies, banks, et cetera. And you know, you talk, what you really learn there is that although fundamentals are very, very important, especially for that long term, that bucket of money you have for long term investments. For those who want to be a little bit more active and have another bucket for the more active trading, swing trades and such, it is a much you have to look at the markets much more differently, and that's where my trading background helps. I mean, if you're an economist or an analyst, you know, you kind of look at what theoretically what should happen 6 months from now, a year from now, 3 years from now, 5 years from now. For traders, we want to know what's happening in the next few hours, the next few days, and the next few months, no matter what the fundamentals partake. And so we use a lot of different strategies, and we obviously we still use those fundamentals, always important. We also use technical analysis heavily. Every great every great hedge fund manager, and I'm talking all of them, use technical analysis in a big way. That's not their own, not even close to their only use, but they use it very, very heavily. We talk Paul Tudor Jones, Jeff Gundlach, you name it. They all do it, and David Tepper, whatever. And then of course we use sentiment, positioning, et cetera. All these different things, because no matter how the market can look no matter what should happen theoretically over a longer term basis, the market can do a lot of funny things along the way. And as my old saying, my mantra is that the old saying on Wall Street that the market is always right is absolutely dead wrong. The market is only always right eventually, and we've seen it a million times. Was the market right at the top in early 2020? Of course not. Was it wrong? Was it right at the bottom in 2000 in the spring of 2009? Of course not. We see the same thing with individual stocks. Was the market right about Meta last week, just before they reported earnings and rallied 20% in one day? So we want to look at a lot of different things for this shorter, more active trading, and it's worked out real well for us. A banner year last year where most people were losing money, and it's a situation. I think the best thing about this chat room though is that we have people who trade together. I mean, trading alone is such a tough thing to do, and we'll talk about that a little bit more. But like I said, the biggest and the best traders in the world at all these hedge funds, they have colleagues on their trading desk that they talk to. They have traders at these other firms, the Morgan Stanleys of the world, and if they're trading, if they're not trading alone, you shouldn't be either. But that's kind of what my background is, and what I'm trying to help people do with trading, is getting help as they trade throughout the day.
Right. So we did a quick poll here, and what is your goal for trading, right? So a few people, you can see the results there, Matt, but basically most people are looking for some cash flow strategies, right? And I know that you can share some of those strategies and show some trades that you've been able to do with this in the live room.
Right, absolutely. I mean, the whole idea, of course, is to capture these things when the market is wrong, and especially at key turning points. And we can do it on a longer term basis, like we did in the oil market, when we pounded the table in a bullish manner in October of 2020, and rode that for a year and a half, and then turned bearish on it in some shorter term trades. I'd say bearish. It was more, we kept the long positions and traded some puts to make some real good money. But I'll show you some situations. But some are. Let me just try to share my screen here. Hold on, just takes me a second. And there we go. And actually, let's do over, instead of looking at Bloomberg, which we will talk about a little bit more. Okay, that's fine. Get that out of my way. Okay, sorry. Stocks. Okay, there we go. Okay. So this is a situation where we want to be able to look at everything. So many people are caught up. They want to trade Apple every day or Tesla every day. Believe me, we trade Tesla and Apple all the time. But we want to look at a lot of different things, and whether it be stocks, commodities, because these ETFs, we have the tools now that we never had before. These ETFs and weekly options and daily options, et cetera. Well, here was a situation where last year we went overseas stocks. The Chinese market in March of last year had become ridiculously oversold. So again, I looked at some of the fundamental aspects of it, and the Chinese. This is the FXI. This is the Chinese large cap ETF, and it says last weekend's chart, but that was done a year ago. But you can see as we went through 2021, their market got knocked down. All their government came in and whacked their different industries. They started with Alibaba and the kind of retail area. Then they went to more technology, and they went to gaming, etc. Every single month they have to go to another one. And every time the stock market would bounce up, they'd hammer another one, and the market got absolutely killed. Well, but at the end, but when we moved into 2022, they didn't knock down their market. We did. The U.S. came in and said, "Hey, we're going to." What we're thinking about through a trial balloon about delisting a bunch of these stocks like Alibaba and some of those other big names, and the market fell out of bed. Well, I knew from first of all, number one, fundamentally the market became very cheap after this big sell-off. That's number one. So that's the fundamental side. Number two, just my experience. I know what happens when China, when their market starts to get hit, especially if it's from outside sources. They didn't mind; they were the ones knocking it down. But when we were the ones who causing it, they're losing face. That's a no-no. I knew they would come in and support their market and buy their own stocks if the government had to, do whatever it took. And then I used technical analysis, and we use this called the Relative Strength Index, RSI. You can see, and we'll go over some more of this stuff. We'll talk about the educational aspect of what we like to do in the chat room. But this is an RSI, Relative Strength Index. When it gets down to the 30 level or a little below, it's a buying opportunity. That's why go ahead and buy. That's why the line is green. And then when you get overbought up at 70, the line is red. Stop buying. So you can see when it got overbought there, you see how the stock went down after that. When it got oversold here, it rallied after that. You see how it got oversold, rallied, oversold here, rallied, right? These are big moves. These are 10, 15% moves. But look how oversold it got here after we talked about delisting some of their stocks. The RSI got the most oversold it had ever been, and the second most oversold I had ever seen anything, any asset. And so we came in and said, okay, this is ridiculous. Let's go ahead and buy the FXI, some FXI calls. And again, it was fundamentally it was getting cheap. Technically, it was getting ridiculously oversold. And then I just knew from experience that this thing was going to that the Chinese government would come in. So what do we do? Well, sure enough, the next day, hold on a second. The next day, let me just go back here. Yeah, the next day, you can see how the market took off, rallied 27% in just one day. That would be like the Dow Jones Industrial Average rallying 27% in one day. And we had gone in and we bought a specific option. That's what we do. We share ideas all the time. It's not just me, the one who's putting in these ideas. But here we came in with a very specific trade, the FXI. March 18th. March 18th, of course, is not the trade date. It's the expiration date of the option, the $30 call option. And we came in and we bought, and you see, we bought them here late on the 15th. That March 18th date is the expiration date, not the trade date. Trade date, you can see down here, was March 15th. The next day, with that 27% rally in the market, the next day, these things opened up 1,000%, these options that we had bought. And I'm like, usually 1,000%, I'm like, hey, let's not get greedy. Let's just move on. But like I said, experience told me that the Chinese government would be buying their stock market, not just for a couple hours. Like I knew it wouldn't be a meme stock where it rallied up for a couple hours and came straight back down. No, I knew the rally would hold. But after we'd been in the market for about an hour or so, these options were up 3,000%. And I said, oh my gosh, we got to take some profits. I know it's going higher. I think it's going higher, but we didn't sell them all. We sold half. So at almost 3,000%, 2,900%, we sold them there. Then we wrote them out the rest of the day. And at the end of the day, we sold the balance for almost 8,000%. So you can see the average was over 5,000% on the full position. And even at the end of the day, I came in and I said, with what the government's going to do, I think this market's going to continue to go higher. but I just can't risk it anymore. It's just too much. And some people did hold on and made over 10,000% on their money.
Matt, really quick here, Matt. And you're posting entries and exits in the live room. So all these trades, you're putting your when you're coming in, when you're getting out, right?
Exactly. We go ahead and we put again, we don't just say, hey, China looks good. Why don't you think about buying some Chinese stocks? No, we gave a specific option that we should buy. In this case, it was the FXI. And again, not just any, don't buy some FXI options. The specific option we were buying, when we were buying it, and exactly when we were buying it, not 2 hours later or 10 minutes later or 3 minutes later. It's right when we do it. And the same thing when we sell it. We're selling them right now. This is a sell. Not, I don't sell it first and then say, wait an hour and tell everybody else about it. No, or, it's when we do it. We do it. When I do it, you hear about it immediately. So at the same, before I do it. So that's exactly what we do. And again, this is something that, this is 8,000%. This is not something we do every week. These opportunities don't present themselves. But we had another one the year before in Viacom, which had become incredibly overbought. Remember I talked about that RSI chart this RSI chart, we got it way down here. Well, for Viacom, it was during the meme stock era, and the stock, its RSI got up to 97, way up here, way overbought. I said, this is ridiculous. And the next day, we did the same thing. The stock fell 60% in one day. We sold half for about 2,500%, the other half with a 5,000% gain. So, obviously a real nice gain that day. Again, those opportunities don't present themselves every day, but we do and have had many opportunities to make good money. I mean, here's one where we made 600% on the SQQQ. Those are the inverse ETF for the NASDAQ 100. A lot of people have heard about the QQQQs. Well, this is the inverse ETF. And I'm sorry, the three times leveraged ETF for the QQQ. So we thought the market was going down, and sure enough, in April. So again, April of last year, remember we had the big one in March. April, we made that 600% on the SQQQ. We can give the VIX. We made 82% over about a couple of weeks on that one. There's some more SQQ. Here's another QQ. I don't know. They're not all just index options. But the one thing that we do use with these index options is that index ETFs is that they really do help. They trade every day. I mean, in other words, they have an expiration. It used to be three times a week, and the Monday, Wednesday, Friday ones are the most active, but they trade every single day. So you don't have to go out into time. Let me see here. I'm just getting some of this stuff.
Hey, Matt, really quick here. We run a quick poll here, basically, about so if anybody has ever, like blown up an account or more, right? So about 40% of the people watching this on the Zoom call, this has happened to them. So it's a pretty common thing, right? I know that you teach some strategies and you do risk management to avoid these sort of things, right, Matt? In the live.
Yeah, we really do try to do that. I mean, one of the things I do is I really try to avoid putting a very big. I mean, it's like 10% is 10% of my portfolio on any trade is by far the most. I usually don't even come near that level. I hear about people blowing up 50% of their account on one trade. Some people that real confidence, and that's fine. But it's the options we've seen some of these. See, here's another one with Apple Computer in May made 400% in just one day, and people held on to it longer, made even more. But the point is, we try to talk a lot about risk management. And if it's an individual stock that you're trading over several weeks, if the stock goes against you by 10%, get out of it. And look for another entry point or walk away. Do not let these things bleed. And when it's an option, usually about 25%. If it gets more than 25%, get out. You can get these big returns, but the big thing is to make sure to limit your losses. Jeffrey Gundlach was the new bond king, and he was on last week on CNBC after the Fed meeting. And it's one of the things he said. He talked about how people, it's vitally important to get out of your losers and move on. And that's really what we try to do. And again, we spread out the risk. Do not have too much concentrated on any one bet. I don't care how, I don't care
Right.
how much you think a Tesla's going way up or way down. It's just not not a good way to do. So that's something we work very hard on with people. A lot of education, a lot of risk management, and of course, we give those ideas as well. But we're trying to, the whole idea is people getting these, all sorts of ideas. That's great. There's that Viacom trade. Remember that RSI that I told about how overbought it got? But you're going to want people, what they're doing and why we're doing it, and that's what we're really trying to accomplish.
Right. And tell us a little bit about Matt's power session that you have on Tuesdays with the folks.
Yeah, it's about two things about that. It's interesting because in our chat room, this is the one I have that you can see on the screen now, which was another really big one, was one I did not get involved with. It was other people in the chat room talked about it, and they asked me, they said, what do you think of this trade? And I said, it's a great trade. I like it. They were talking about how Amazon was going to be, was about to split. And then other times that it split in the past, the stock had rallied a lot. Well, I had other positions and stuff. And I just said, hey, I'm not going to play it, but you go ahead and play it because it really looks like you could play it. Well, I wish I had. And then they made 500% on part of their portfolio and almost 1,500%, or more than 1,500% on another part of their trade, not their portfolio, but on their trade. And, again, I wish I did not get involved in this trade. These are the ideas that we're getting for other people in the chat room. So it's a great community. But to go back to what we're talking about on Tuesdays, we have this session that's it's a Zoom session, just kind of like this. And we start fun. We just say, we'll do something for 15, 20 minutes and just kind of maybe do some education and stuff. But it's just turned into a much especially with the volatility of the markets, it's turned into a much longer thing, 45 minutes to an hour nowadays. When we did it around the holiday, it was things were a little less active. So it was, I think then it was like 35, 40 minutes long. But usually, and we talk about what we're talking about, what's going on in the markets. We talk about education. This past week, we talked about several different education. I spent the first half hour talking about educational things, certain aspects of technical analysis, and certain aspects of how certain options trades work. We also talked about how the buying and selling. We didn't really specifically talk about gamma, but it's something I'm going to talk a little bit about today. But the impact of how the market can get pushed up too high or down too far when the options traders get positions that are too crowded, which they are starting to get right now. That's part of the reason we're seeing this extraordinary rally in the face of some negative news on earnings. And I know we get some positive news from the Fed, but again, we talk about a lot of different things as a full hour, usually a full hour. And if I'm not going to waste your time if there's not much to talk about, but it's something that's worked out really well. I think that everybody in the chat room really enjoys it. I like to do it on Tuesday because it's let's get into the week a little bit, and we don't want to do it at the end of the week because it's almost over. So we do it 11:30 Eastern time, and like I said, it usually runs to about 12:15, 12:30.
Right. Do you think there is a trade to be made because of the balloon thing? Or no? Some people in the chat room are asking. So
well, I just don't know. I mean, it was funny because the balloon thing was actually out on Thursday. It's not the main reason the stock market was down on Friday. I do think it's funny because I think this, like I said, and I'll show you again as we go through how the market's overbought. The NASDAQ, the S&P, the Russell 2000, which is the small cap index, they're all getting overbought. Apple's overbought, Tesla's overbought, the transportation index overbought. They're all kind of overbought. So we're even if it's just a sideways breather. I mean, if you're a real bull, you should be looking for at least a breather here. My feeling is that we got that sell-off on Friday. We may see a little bit of a follow through to the downside, especially with this balloon incident on Monday. I'm going to be one who's, because we do have some bearish bets on in the chat room. I'll probably be taking profits on those Monday morning, looking for a little early week bounce, and then we're going to really look at it later in the week to see if this overbought condition we can take advantage of it on some bearish bets, even for those who are looking for the market to go a lot higher.
All right, so we put a quick poll here, Matt, on and it looks like 50% of the people here watching haven't an open options trade, right? So maybe we can go over some of their trades and kind of, just give them a little taste of, what typically could happen, like happens on the Tuesday sessions, or how you analyze these stocks. So folks, if you do have a call or a put the strike price expiration. All right, Tinvet. All right, really quick. Let's so JWN $27 put expiring February 17th, paid $240.
So is this N is in Nordstrom, JWN is in Nancy?
Yes.
Yeah, okay, so that's what I figured. Yeah, they reported last week. Oops. What's going on here? Okay. I'm sorry, so can you just repeat again which option you hold?
$27 put.
$27 put. Okay. Now
Expiring February 17th.
17th. So you got 2 weeks left. Okay, good. Well, I mean, you can see the reported earnings and the stock shot up. Okay. Now again, let's go to the goodness, excuse me. Let's go. I just want to get rid of some of these lines here. This gets a little busy here. And then we'll go back to here. Okay. Now, see how it shot above its 200-day moving average. See how the 200-day moving average was tough resistance. It got above it, got slightly above it, but only for a couple of days. And each time it fell back. Then it got right to it, fell back, got right to it again. What's it going to do? Is it going to fall back? No, they reported good earnings and it shot higher. So you say, oh my gosh, this is great news. It finally broke its key resistance level. This thing's going to the moon. Well, maybe it is over time. I don't think it is, but I really don't want to buy it on a short-term basis. In fact, I think I'd rather own puts, and I think these puts are going to work really well for you. Look how overbought. Look at that RSI, 88.11. I hope you can see that there. Now let's go back in a little ways. I'm going to guess this is the most overstocked the most overbought this stock has been in a long time. I'm going back a full decade. Okay, more overbought than it was here. Here. Let's just see here. I just want to take it. Bang. Oops, sorry. Right, yeah. Yeah, see, even in here, it just didn't, this is the most overbought it's ever been. Let's look at it on a weekly basis. It's hard to see because I'm going back so far. But weekly basis is not as, okay, now here's another reason. And the weekly basis is not as overbought as it was at the beginning of 2021. But remember, at the beginning of 2021, the Fed had not started hiking interest rates, and QE was still taking place, right? So the market started rolling, I'm sorry, and that was actually, they were still at, what am I talking about? I was thinking early 2022. 2021, they were still cutting interest rates and plowing money into the marketplace, right? So that's why it was able to get incredibly. Now, remember, this is the weekly chart. Look at it now, though. Even with all that liquidity and zero interest rates, the stock had a tough time holding above its 200-week moving average. It's getting overbought on its weekly average, and it's testing its 200-week moving average. Without that liquidity and without zero interest rates, I don't think it's going to be able to break through. Also, you look at, again, that's the weekly RSI. So on an intermediate term basis, it's starting to get overbought, not crazy overbought, but starting to get there. But again, when we look at the daily, we'll go back to that. Bang, and let me tighten this up so it's not, we'll just go back a couple years instead of 10 years. But again, look at that gap opening higher here. Look how overbought that thing is. It is very, very overbought on its relative strength. It is most overbought it's been probably ever. So this is going to be a stock. I think it has to come down further. Let's look at another thing. It's called the but. Again, I talked a little bit about the relative strength index and why that can be very helpful. It's not perfect. You can see how it got over. Let's blow it up here. See how it got overbought, near overbought. But this time, in this case, it had to get way overbought. So it's not a perfect thing, but when it gets this extended, 88. I mean, can it go higher for another day or two? I suppose so. But you've got 2 weeks left in this thing. There's a good chance this thing's going to get hit. Now, look at the other one. Again, the educational thing, Bollinger Bands. Okay. Now, what we're going to show here, I'm going to get some of these lines out of the way so it's a little bit easier to see what's going on. But see these lines here? See this gray line in the middle? That's the 20-day moving average, not the 200, the 20-day. That's a 20-day moving average, which is something that short-term traders look at all the time, okay? This orange line Take it back. There's no orange line. This purple line is when the stock gets 2 standard deviations above its 20-day moving average. This green line is when it gets 2 standard deviations below that 20-day moving average. And look what just happened. See how it got above that? It got above more than 2 standard deviations, and it's sold off immediately. Here it got up to that line a bunch of times, but never really got above it. But here it did. See how it got above it? And sure enough, let's just look at it here. Well, okay, so it went down. So what? Well, look at this decline. Hello. That's a 17% decline. All right. Now this stock is off its highs from Friday, but look how much above its Bollinger Bands chart it is. That is unbelievable. That is ridiculously extended on what they call the Bollinger Bands chart. Now, there's more to it than just 2 standard deviations, but I think that's just the best way. But see, we don't see it anywhere. It's so hard to see because but there's nowhere. This is the most overbought the stock's ever been. So I'm telling you, I think own some real good puts, especially if you bought them on Friday. You got probably a great price on it. And I think this stock, okay, so let's go back and say, so where's the stock going? Okay. How much can it fall? I mean, it's hard because they did get good news. I mean, they got good news on, oops, put the wrong symbol, I put M instead of N. Okay, boom, boom. Here we go. Again, we saw this. I'm going to get rid of some of these lines. Just so these other 2 lines that's the 200-day moving average. The other are the 50 and 100-day, but they're not as important right now. At least not right now. Okay, yes. I just want to look at. So this is something else I look at. Again, what they call. I don't know how many people are familiar with the mathematician Fibonacci. I guarantee you, I had never heard of him until I came to Wall Street. But he's been around a while since the 1400s. And again, I'm not going to go into that. To spend hours talking about his mathematical thing, but he basically says everything in the world is based. So much of the world is based on mathematics, and you have these certain retracements in all sorts of different aspects of life. And one of them is that in the markets, things retrace on a certain scale. And so what we're seeing here is there's the high, there's the low. Oops, shoot. Let me get rid of that. Fibonacci. This is here. Oh, okay. Again, he goes by, basically 1/3, 38.2%. That's that green, or 2/3, 1.8, or 50% retracement. Okay. Now the 50% retracement is also the same level as the 200-day moving average. That's a real good target. Okay. 21. This stock could go back down to 21. Now, is it going to happen because the good news? Maybe not. But the 38% retracement, I think, is very likely. Is quite. There's a chance it's 26. That takes it back down to below 23. You're going to make some nice money on that. We'll see what happens. The next couple of days will be interesting. See if the balloon impacts the market. But I think as we get later into the week and the market, focuses more on just how disappointing this earnings season has been, and especially now that the interest rates have bounced back after Friday's employment report, and people aren't so enthralled with the Fed cut rates. But this is one I guarantee you. Thank you for the idea. I'll be looking at this tomorrow. We'll see what happens. The stock opens at 24. I probably won't buy puts, but you'll make a fortune. So we'll just have to see how the stock opens. But this is I think something that's going to do really well.
Yeah, interesting. And that's the good thing about the community, right? They all bring in tickers and you can analyze them.
Absolutely.
So, all right, somebody has a question. Yeah, so Matt only buys calls and puts. He does not do spreads, condors. The most I've seen him do is a straddle. It's basically a strategy that focuses on capturing volatility, right? So we're getting a lot of questions here, Matt, about the chat room. So we can go through this really quick. Then we'll get back to analyzing a couple more trades from the folks. All right.
Sounds good.
So, okay. So good questions here. Does Matt Maley go over member trade ideas? Yes. Just like now with JWN, this is something that, you can always request. You can, ask Matt, hey, what do you think about this and such? You do have a live room where you can talk to Matt right back and forth and everything, and with the other folks. Are the sessions on Tuesdays recorded? So yes, Matt's power session on Tuesday is recorded. It's available for everybody that's in his room, pretty much. What is the chat room schedule, Phil? So the chat room is open 24/7. It's open. There's people pretty much from all over the world in it. So that's open the entire day. As far as Matt being there, answering questions, going back and forth, having a communication, market discussion, trade ideas, all that stuff. He's there from like 8:30 till about 5 p.m. So before the market open, and after the market closes. So the entire day, basically. Good question there. Let's see, is this yeah, it's volatility trading. So that's the strategy. That's the type of trading that Matt does. Let's see, strategies. Right. So these contracts they expire in short term, right? They're short-term expiration contracts. So they don't have a lot of premium attached to them. We're talking about contracts, for 60, 70, 80 cents, right? So $80, $90 around there per lot. So it's easier to scale in. It's easier to scale out. As you'll see in the chat room, Matt does that a lot. Like with some Rivian puts, he sold some of them for 100 and then the others for 180%. So good question there. Let's see. Do you teach strategies? Right. There is a lot of education. So I think some of these questions, I just grabbed the ones that were most common, but we're going to be putting the link in the chat for everybody that wants to join Matt's room. Okay. It is volatility. Correct. Now, Matt, is there anything that I might have missed or anything in particular that you want to add to the live room? I know you do a lot of education there, trades, entries, exits, you get push notifications. You just download the app. So what do you what else can you add there for the folks who want to?
Again, the one thing I just, it may sound self-serving, but I'm telling you, it's not just, the people in the chat room will tell you that there's a lot more people in that room giving great commentary all day long and asking really smart questions. And the other thing, one thing I do was funny because I was asked last week a question, and the person kind of said, I don't want to ask, too many stupid questions or too many questions. I'm not the only one answering some of these questions. I mean, a lot of people are very, very helpful. We're there to help you. There's a great group of people. It's not 30,000 people in some chat room where you don't have no idea who's in it. These people, you get to know them a little bit, and we joke around with each other and have some fun. But the point is that again, I went back to what I talked to at the beginning. If a guy's sitting for working at for Paul Tudor Jones or any of these great fabulous incredibly successful hedge fund managers, they have a trading desk with several traders, in some cases a couple of dozen traders. They're talking to each other all day long, and they're talking to traders from Goldman Sachs and Morgan Stanley and Citigroup and Bank of America, you name it, smaller firms, Miller Tabak, et cetera. And, so they're seeing stuff all the time. Have you seen this? Have you seen that? Did you hear this news? Like for me, one thing I've stayed away from all my career, because it's just stupid in my opinion, is passing along rumors. I mean, hey, so-and-so is going to take over, Tesla's going to take over so-and-so, or Apple's going to take over Tesla. Those rumors, but if suddenly a stock is up and it's because of a rumor, I'll say, well, there's a rumor out there. Be aware that it's a fact. There's a rumor out there. Whether it's true or not, I have no clue. And but the point is, things like that are being bantered around Wall Street all day long. These guys are hearing this stuff. These traders, these big hedge funds, and even some of the hedge funds in the country are incredibly good, are relatively small. They like to stay small, but they're all talking to a couple of dozen traders every single day. And so if they're not doing it alone, how can you do it alone? And
Right.
That's really what we tried to do, and it's worked out really, really well. A lot of people, giving each other good hints, different levels of, hey, I'm new, how do I do this? And they'll say, hey, read this book, or here's a real good, trading for dummies, whatever happens to be. Look at this website. People are helping each other out all the time, and it's just something I think is essential if you want to be an active trader. Again, if the guys at the big hedge funds are doing it, how are you going to compete with them if you're not doing the same thing?
Right. So let's grab a trade from the YouTube side. Let's see. Let me find something here. Okay, so Joe Shep has SoFi $7 puts expiring March 3.
Okay, so just a month left on those. Okay. Okay, now I always hit up the RSI chart first, but that's not necessarily the be all and end all. It's just one to start with. But I look at stochastics, I look at Bollinger Bands, I look at MACD charts, and then of course I look at chart formations. Head and shoulders patterns, and we'll talk about some of them. But head and shoulders patterns, ascending wedges to symmetrical triangles, etc. So we're looking at all these different things. So you own the what's the strike price, Rodrigo?
$7 puts, $7 puts.
$7 put. Well, and you got a whole month before it. Just want to get rid of again some of these lines. Well, let me get the 50-day back there to see where it is. Okay, it's no big deal. Okay, again, look at this thing. Look how overbought it is. I mean, it came down a little bit on Friday, like everything, but its RSI got to 85. 85. That on Thursday. That is really overbought. It's hard to see this, I'm sure, on your screen. Let's just go back. Oops, hold on a second. Let's go back a few years. Now, of course, SoFi hasn't been trading publicly for that long. So you can see it's by far the most oversold it's ever. I'm sorry, overbought it's ever been. Well, let's take it back. It got when they first went public. Right when there was people, that's one thing I want people to know, right before the pandemic hit, they went public, this stock got ridiculously overbought, and there was also a QE program going on then. A lot of people don't realize that but it was actually in September of 2019, I'm sorry, I take it back. Okay, I'm talking about the wrong, 2000, I'm getting my, yeah. So right here, this was not before the pandemic, but it was while the obviously the Fed was heavily involved in QE, heavily involved in interest rates at zero. So it went public and it got overbought. But we're almost to that level. And look what happened after it got after it got that overbought, right? Again, it's this overbought. See this RSI chart? Very, very overbought. And we have again a completely different situation. Here we got the Fed with zero interest rates. Now we got interest rates in the mid threes. Here we had QE. Here we have QT, and it's just getting ahead of itself. Now, let's switch and it's just, so I think and again, okay, let's go back here a little bit. Okay, this stock was trading at 7 3 days ago. Tuesday. All right, so. And I think this market, and we'll talk about positive gamma, it has to do with interest rates. But again, some of this educational things, some of this artificial buying because of the some weird things going on in the options market, this stock got overbought. But let's go back to the what we talked about before with JWN Nordstrom equity and Bollinger Bands chart. Boom. See, again, let me make it a little bit smaller so it's a little bit easier to see. Boom. But see how it got well above its Bollinger Bands chart? Okay. And when it gets back below it, it usually falls further. And then I'm going to show you one more thing. But again, see how it got above it? Well, look how far. Well, geez, well, I don't know. Look, when it gets above that Bollinger Band, see how much it came down? I mean, that may not seem like a lot, but let's see how the percentages, right? Right here, bang, got above it. Okay, thank you very much. Down 28%. You know what? How much those options go up when stock goes up 20? They go up many hundreds of percent. If the stock goes down 22%. Stock's down a little bit already, but this stock should fall further. I think if there's a good chance it falls. So it may not do it immediately early next week. It may be later in the week, but I think by the time we get into March, there's probably a good chance. Now, I want to look at one other stock. Again, these different things that we talk about. Hopefully, I'm helping you learn some things about Bollinger Bands charts and all this stuff. Now, the other thing to look at that will give you a lot more confidence is this is what's called the MACD chart. And what it shows, again, I'm going to get rid of some of these lines. Okay. It shows it's something we follow the 12-day and 26-day moving averages, exponential moving averages. And when they cross, when the shorter term one, the 12-day crosses below the 26-day, it means the momentum is shifting lower. When it crosses above that line, Means momentum is shifting higher. See how it crossed above that line and see how the stock rallied nicely? Well, it's just now starting to curl over. It hasn't done that yet. But if this thing, see what happened, what happened here? It doesn't happen right at the top because it's a moving average, so it takes time. It confirms a change in trend. It doesn't signal a change in trend. Okay, but here, see how I want to turn down here? Okay, see how we got the negative cross there? Again, it may not seem like a huge decline, but again, it didn't top there, but still went down another 20%. Okay, right here, it crossed here, and I said, oh, geez, it didn't really go down a whole lot further. Well, actually, it did, because this is where it was, and it was over time. No, that was 26%. That was a full month. But even here, even over the next week, it was down 14%. You see how it's because it's such a low price stock, it doesn't look like much on the chart, but that's a 14% drop. Your stock drops 14%, you're gonna do, well, let's see here. Let's see, if we get the cross, it drops 14%, and the stock is going, down towards $6. So those options are going to fly. So those put options. So again, it's another good one. I don't know how I do think we'll get a little bit of a bounce, especially if we open lower on Monday. I think you'll get that knee-jerk reaction every time we open lower. We get a little bit of a bounce back. But then as we get in the midweek, we go back down, and I think things are going to be tough. And I was showing this thing earlier. I'll just go really, really quickly. Again, it's like everybody's like, well, it doesn't make sense. Everybody was bearish. Remember how everybody was bearish at the beginning of the year? Well, I mean, the market kept going up, but got a little bit overbought. This is the S&P 500, right? But now it's getting, well, here, and sure enough, it came down, but only for a couple of days, went back up. Now it's getting more overbought. And again, it's about as overbought as it was back in August, just before the market rolled over, and more overbought than it was in March. When it rolled over in a big way. But the same thing is for all of them. Here's the NDX, the NASDAQ index, the NASDAQ 100, which is the one most people look at. Same thing. See how, let me get rid of the volume just so it is trying to get rid of some of these charts so it doesn't get quite so busy. Let's see again. See how overbought? It's not wildly overbought. I'm not saying it got more overbought in 2021, but see how got to say it was more overbought than it was in August when the thing rolled over, well more overbought than it was in March just before it rolled over. So it looks like it wants to roll over. And the thing is, you say, well, geez, all these positive things that happened in the stock. And I totally understand. See how it got, see how the 200-day moving average, that was tough resistance there, didn't quite get there. It's finally breaking above it. That's bullish. Okay, great. We also have a higher high. One of the most important things to know in technical analysis, very simple thing. When you see stocks making higher lows and higher highs, that's bullish. When they start making lower lows and lower highs and lower lows, that's bearish. But when you start making a bunch of this was lower high, lower low, lower high, lower low, lower high. Ooh, we didn't make a lower low here. This might be good. And now we've made a higher high. That's good. But it won't happen in a straight line. Again, we're getting overbought on that RSI. My point is that the overall market, we want to be a little bit careful, even though some people are saying that this is, the bear market's over. If they're right, I don't think they are, but if they are, even if they're right, it's not going to rally in a straight line. Again, this is the Russell 2000 index, same thing, just as overbought as it was. See that? Again, let me get rid of some of these charts so you can see a little bit better volume. But again, this Russell 2000, which is a small cap index, again, you can see how it's more overbought there than it was at other peaks last year. And believe me, I'd be thinking it different too. I say, oh, the market could get more overbought if it was 2021 again, or if something was taking place like it was in 2021, where the Fed was doing QE, not QT, and the Fed interest rates artificially low, down near zero, and not, so this whole thing with it, a pause is the same as a pivot, is not true. It never has been true. No bear market has ended since World War II until the Fed actually started cutting rates. So the stopping of raising rates, it's not negative. I mean, I guess it's helpful to a certain degree. But when the market is really expensive, like it is today now, 19.7 times earnings, That is expensive. Those types of market can't stay that expensive unless you have excess liquidity. We don't have excess liquidity right now. And again, even if you believe, even if God came down and said, you know that I'm telling you right now, 6 months from now, the market's going to be higher. God's told you, so you know it's going to be higher. I'm just telling you, even if that's the case, absolute fact, at some point soon, we're going to have to see a pullback. That will be, and to be honest with you, that would be normal and healthy. You don't, overbought markets, if they get overbought markets don't see pullbacks, they get extremely overbought, and then the pullback becomes a much deeper one and creates all sorts of problems. So again, so hopefully we get an idea of why I'm thinking. We can debate all day long about the fundamentals. And whether whether inflation is really going to come down to a serious level, and we can't talk about that if you'd like, or if
right, yeah,
all these other things. But the point is, when a market gets this extended, especially when it's expensive, especially given that the earnings season has actually been the worst, this quarter so far has been the worst since 2010, according to Bloomberg, in terms of earnings.
Wow, that's very. I mean, did you expect that? Look, Dorothy in the chat says that she's feeling bearish. So do you agree with Dorothy, Matt?
I do. The thing is, couple of things is what's really caused this market to rally. I mean, the big talk has been the expectation that the Fed is going to pivot. The Fed is going to pause. Okay, fine. The thing is, I was saying, and most people were saying last summer, that the Fed's going to pause early in the first quarter of next year. It's probably the last time they raise rates. We've known that all along. The problem is that they pushed interest rates up. Take that back. They pushed interest rates so far, it took them down to zero, and that took the stock market so high that it takes longer, to work off that condition. The Fed did what they had to do. They did the right thing. They lowered interest rates in a ridiculous way that pushed the stock market way above its underlying fundamentals. We all knew that was going to happen. We figured once the pandemic, we got through the pandemic, the market would play catch up. The problem is they kept that liquidity spigots open. We never been able to catch up. So at some point, as the economy, we got to meet somewhere in between. That's what we've been trying to do. And the thing is, every single bear market since World War II, every one of them has not bottomed until the market got below 15 times earnings. And if that's the case now, especially with earnings going down, that takes you to somewhere around 3,200 on the S&P 500. That's much lower than the lows from last year. But they say, well, the economy's doing better. Or we're going to get inflation under control, and you look at the jobs report. People are spending too much time looking at the economy because the stock market is still too far ahead of the economy. All right, so even if we don't have a recession, the market still has to come down. It's like, what the hell are you talking about, Maley? That can't. It's always you look at the economy. The stock market is a reflection of the economy, and that's all we care about. That's actually not true all the time. Okay. When the market gets to ridiculously high valuations, like it did at the end of 2021, right? It doesn't matter. It has to come down no matter what happens to the economy. And it's, again, what makes you say that, Mr. Maley? Well, I'll tell you what tells me to say that. Because there's only been one other time where the markets got ridiculously overvalued like they did, even more so. And of course, that was the end of the 1990s. Well, in the end of the 1990s and early 2000, okay, it got ridiculous. Guess what followed? One of the most mild recessions ever. Okay, in 2001, 2002, one of the most mild recessions the U.S. has ever gone through, and yet the S&P went down 50%, and the Nasdaq went down 80%. Why? Because the market had become so ridiculously extended on valuations, it had to come down, even though the recession was a very, 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 very mild one. Okay, now. This time around, thankfully, the most of the valuation levels didn't get anywhere near as extended. So we're not going to have to fall 80% in the Nasdaq or 50%. But I do think we're going to have to fall more than 30% on the S&P and probably 40% in the Nasdaq, and maybe more in both. But the point is, and that's the other thing too, is when the Fed's going to pivot. The Fed has never pivoted ever. Well, I say ever since World War II. I don't know what happened before World War II. My guess is that the same is true for since before World War II. But 70 years, 80 years almost now, the Fed has never pivoted until things get bad. I mean, we always know they wait too long, right? They take too long with they kept the liquidity spigots open for too long in 2021. Now they're gonna keep tightening too long, keep interest rates tight because that's what they always do. They wait until they have full proof. And again, the Fed does not, just like I said, the Fed. There's a reason. The market always gets. They do not start cutting rates until the stock market falls a lot and becomes cheap. Now, part of that you say because maybe the Fed can do it this time, but the real part is because of leverage. The amount of leverage we built up. Okay, we still have 600 margin debt right now is still $600 billion at the end of the year. If anything, it probably went up a little bit in January. That's still higher than that's still higher than the highs of 2007. Okay, so it's come way down. But the point is, when you unwind the reason why whenever markets get overvalued, and usually you only get slightly overvalued. This time and again in 2000, they got way overvalued. Well, you unwind that leverage because people get really cocky and really confident, and they add all sorts of leverage as the market goes higher. That causes the market to move higher. But it works when they unwind it, the same thing happens. Because if the market's going down and you get a margin call, that's what happens with the unwinding of leverage. You get a margin call, and suddenly that's why bear markets don't stop at fair value, because leverage has to be unwound. And when you have the side of the leverage that we still have, the chances are good that the same thing will happen this time, right? Because people get the margin call and they say, I need money now. I mean, do you have the money? Do you want to write a check, or do you want to sell the stock to cover it? Sell the stock to cover it. That's what they do. And I don't have the money. Okay, so I have to sell the stock. The stock is now fairly valued. Doesn't matter. The bank wants my money. I don't have that money. I've got to sell the stock. Forced selling. And the thing is, I'm not calling for a crash, but one thing about crashes, their crashes are not caused, crashes are not caused by high interest rates, poor earnings, high inflation. No, those things can cause bear markets, but the only thing that causes crashes, one thing and one thing only: forced selling, margin calls, things like that. Forced selling, because people. That's what causes crashes. It's like, oh my God, get me out. It's kind of what happened. We did see a crash last year, of course, in the cryptocurrency market. But that's but it usually doesn't get to that point. It's just, but we can get this. But that's why when people always talk about, I'm sure you heard this year, we haven't had that washout yet. You don't always have to have that washout, but there's a reason. It's not just a weird coincidence. There's a reason. There's usually a washout move. A washout move happens because there's usually forced selling at the bottom. Everybody thinks that it was panic. In 1987, people panicked. No, people didn't panic in 1929 either. They had margin calls. That's what really causes. Yes, you do have some people who panic and just get me out at any price. But a lot of those people, most of those people who are saying get me out at any price, are saying so because they have to. They have no choice. They're getting a margin call or something like that, and they have to sell the stock. That's what causes. So they call it the panic 1920. No, it's a crash because of the leverage. We still, like I said, leverage has come way down. The margin debt has come way down, but it's still it hasn't fallen. It usually has to fall about 75%. It hasn't even fallen 50% yet.
Right.
And it's still above where it was. So that's a long thing that made me say that, hey, we got a lot of reasons that, and we can go over why the market has rallied. Here it has to do with fear of missing out, short squeezes, and positive gamma in the options trading. And at some point soon, we're going to get some negative gamma, and we have some scary declines too.
I want to give a big shout out here to the newest family member. He just joined here on the live room. Mike, welcome.
Welcome, Michael. Great to have you here, and looking forward to next week's going to be another interesting one. It's funny because we don't have. We do have plenty of earnings reports, very little in terms of data, economic data, but we do have the Fed chairman is speaking again on Tuesday, and so he can clarify some of his comments, number one. Number two, I'm sure there'll be a lot of other Fed members of the Federal Reserve speaking. So that'll be interesting to see what they said. And then we get a bunch more earnings. But it is weird how the stock market rallies so strongly after the Fed chairman's comments, but how often the market does one thing right after he speaks and then does just the opposite a few days later. Well, sure enough, that's what's happened this time around, where market rallied on Wednesday when he spoke, Thursday, and then rolled back over on Friday. I think it's going to head lower too. We still, I think, early next week, people will wait to see what he's got to say on Tuesday. So we might get a little bit of a bounce back. But I just think it's just we have to look at history and these people who, I don't know how they can try to say the market can go a lot higher from here when they admit that earnings are going down and that the market's expensive. And they said, well, we're going to look past that into 2024. Well, guess what? Earnings estimates for 2024 are coming in. You can't look 12 months out. You have to look 6 to 9 months out. But either way, 2024 is still not the kind of numbers that would justify today's valuation levels.
Matt, so just for those folks that are maybe not familiar, what is really the difference between, the typical person, that goes on CNBC and talks about the markets, and, has a certain position, and yourself, right? What is the difference?
Well, I mean, there's a lot of very, very, very good people on there. And I think the people at CNBC and Bloomberg and Yahoo and these other places are really good journalists, and they ask good questions. But the answers that come back are many times, I mean, there are some people who are always honest, but I mean, a lot of these people are paid to be bullish. That's their job. I mean, they're not told, hey, you be bullish, but I mean, just look, I forget the exact numbers, but the numbers of buy recommendations, hold recommendations, sell recommendations. The sell recommendations are like 7%. I'm like, you trying to tell me, especially last year, you're trying to tell me of all these companies, all you analysts, the best you can do is say, well, why? Because if they have a sell recommendation on a company, the company's not going to talk to them. And they
lose them as a client, basically.
Exactly. And you could lose them as a banking client. There's also, again, if you put as a sell for a short period of time, but they just don't exist. And that's why some people say that a hold recommendation is really a sell recommendation. And then you go, well, and then analysts will really literally say sometimes, hey, I downgraded this from a buy to a hold, but it's really a hold. It's not a sell. They actually have to say that out loud. They have to say that, that they really don't put sell recommendations out. And how can you take it honestly? How can you take them seriously if that's what they do? You have economists come out. When do economists tell us when we're going into recession? After we're already in one. Happens every time. You almost never will hear. I mean, when Goldman Sachs said there's a 35% chance of a recession, that's like what they're really thinking is that like there's an 80% chance. They'll never go over 50%. I'd say maybe a few firms will just try to if they're truly trying to stand out, they'll say it for a little while and they'll raise it above 50. But nobody's saying, we're definitely gonna have a recession. It's just not. They're paid to be bullish, and the same thing with people who work at money management firms. They have their analysts on. It's like, hey, their job is to keep people in the market, and it's like, it's sorry, it's just the way it is. And thankfully, I work at a firm where they're like, no, you tell us. We care about what you really think, and that's why I have some of the smartest money managers in the world read my stuff every day, and it's and I talk to them every day, and it's again, I'm not afraid.
You call it like it is. You call it like it is. Exactly. You don't sugarcoat stuff. And just for those that are not aware, really, basically, so Matt does analysis and research on the markets, and then that is then sold to institutions, right? So that they can make their investing decisions. So keep in mind, you have Matt Maley in the live room giving you picks the entire day, right? Entries and exits. And on top of that, you do get that high level, that high quality level of market analysis that you do with Matt, right?
Right. And it's like, well, again, I've been doing this a long time, and they wouldn't have me on TV if I didn't know what I was talking about. And I wouldn't get these firms wouldn't listen to me if they didn't think I knew what I was talking about. And so again, some people are taking victory laps all the time and saying how smart they are, and it's amazing to me how often some of these people come on Wall Street and say one thing, and 3 months later, it turns out they're dead wrong, but they claim that that's what they said. They were really, really bullish, really bullish on the stock. Stock goes down and said, well, we turned bearish on this stuff. Like, no, actually you didn't, but whatever. I can't worry about that. But believe me, I've been wrong before. I'll be wrong again. And when I do, I just admit it and try to move on. But it's a crazy system, and but that's kind of what we just have to be able to know. You just have to realize where they're coming from. Now, the market usually goes up, so that's right. That's I'm not trying to say all these guys are all lying and things like that. They're kind of psyche. They're taught. I mean, that's how they think bullishly, and that's what they do. And so it's not necessarily being saying, "Hey, I think these stocks are going to go down," but I have to be bullish. It's no, they're just kind of, it's ingrained into them when they're being trained at an early age to be on the bullish side, and the market usually goes up. Right now, we're in one of those situations where the market is too expensive, and the change in policy by the Fed is going to cause the market, I think, to still see some rough seas in the months ahead. And yeah.
And Matt, I know you follow sports as well. Maybe one day we'll see you at Sports Center with your sports picks there as well. So there's like an analogy or something that you were talking about the stock market, right? Well, I think it was with football or baseball. I don't remember.
Well, it was funny. I went out with the same. I'm up here in New England, and I was a big New England Patriots fan, and a big New England Patriots fan, and a big Tom Brady fan. And there was one year when we came out, the Super Bowl was coming up, and people at this point were just sick and tired of the. If you lived outside of New England, people were sick and tired of the Patriots winning, and most people didn't want them to win. And I was like, I wrote a thing, and it was actually accurate, but it's like how often the stock market, when every year that Tom Brady won the Super Bowl, the market went up. And every time when he lost to the Giants twice and the Eagles once, the stock market had horrible years. And then it's like, and you want to make sure they make the playoffs, because if they don't make the playoffs, which was 2008, remember 2000? Well, of course, that was a horrible year for the stock market. I do have fun with that. And then we have, I'm sure you've all heard the NFL predictor, but a lot of that, again, that's just having some fun. And but there are people who literally take some of these issues that are complete trivia. I mean, this whole thing about, hey, the first 5 trading days of January, what? I mean, you kidding me? Well, say the whole month of January. Now, it is accurate. If the month of January is up, the whole year is usually up. But it's not, that didn't work so well in 2002 when January was up and the stock market was down 40%. Or 23% that year. And that's when it closed. The worst level was even worse. I mean, it was one of the worst bear markets. And the same thing, everybody talked about how the end of the year, we really made some nice money in December of this year, when everybody was saying, oh, it's an election year, market always rallies, especially in a midterm election year,
Right.
Market rallies in December. And I said, actually, you're comparing apples to oranges, because if you look at election years when you're bear market, which was the most recent one in 2018, the most recent mid-year election, the stock market went down. Sure enough, it went down. We did really well. Most of the people got killed because it's a bunch of trivia. I mean, are you going to sit there in July and say, Taiwan's invading? I'm sorry, China's invading Taiwan. I'm not predicting that, but I'm just saying. If you say, oh, don't worry about it, market's going to be fine because the market was up in January, so I'm just going to keep buying. It's just stupid, but it's still fun to have some of the, we talk about these things.
Right.
Just have fun. So it's
all fun. It's all fun, man. I know that the chat room, I mean, a lot of people have fun there as well. And Matt, so let me ask you something here a little bit more on the serious note, as far as where this is going to go. Obviously, debt ceiling, that is a big concern, right? It's not even a ceiling anymore. It's always been going higher. Is this a problem? And the other question when you're done with that one is, where and when do you think the Ukraine-Russia conflict is going to end? Do you think it has an end sight? So those two questions for you.
Yeah, I think that the debt ceiling that will get raised. It will probably get pushed to the 11th hour, like it always seems to. I don't think the markets will be hit all that much from it until we get to that 11th hour, and then they'll have no choice but to people start having to hedge some things, because let's face it, some of the really stupid things that people have done in DC, they could blow it this time. I don't think they will. I think cooler heads will prevail. But if they don't, and we look what happened the last time we defaulted on was it 2014? I think the stock market got crushed. It bounced back relatively quickly, but I don't think that a big deal. I just there's just too many problems, especially with as we're moving into as we get later in the year, because they can push it off for quite a while. Then we start working about 2024, and I don't care which party you're in. If you're if we have a disaster because of that, and because you didn't act and raising the debt ceiling, it doesn't matter if you're Republican or Democrat, you're going to be easier to beat in 2024. So I think that'll get taken care of now. As for the issue of Ukraine, this is it's becoming a war. It's been a war of attrition now for quite some time, and it's looked like Russia was losing and Putin was about to get deposed and things. Well, now suddenly he's going to have 200,000 more troops, and this is going to be with us for a while, and especially now with Ukraine talking about they want to join the EU, join NATO, and that we're saying, and this is the one thing Putin was like, whatever you do, we cannot have Ukraine in NATO, and that's fundamental to their safety. I mean, Napoleon came over, Hitler came over. They need that buffer zone, and it's just something that they're going to fight tooth and nail. I guess my point is, as bad as Putin has been, Ukraine isn't. Some things are happening on our side that aren't as they aren't exactly helping it. And let's say that Ukraine is a very corrupt government. I mean, we're standing with them. We should be. Don't get me wrong, but these guys are not Boy Scouts, so
right.
Boy Scouts or Girl Scouts. So I think it's going to go with us for a while. And let's face it, on Monday, that's when the refined products can no longer be bought. Russian refined products can no longer be purchased by Europe. It's going to be interesting to see what kind of impact that has. It's oil prices and food prices aren't going to come down as much as people think if that war continues.
Right. So, and as far as just on that note, the situation with Taiwan, do you think, so if that escalates, obviously semiconductors will get crushed, right?
Yeah, we rely so heavily on Taiwan semiconductor, and whether they're trying to take some over or a war, if it's just a war, I say just a war. If there's a war, that's going to last a while. And if they take them over, what are they going to do? I mean, if they somehow can take them over peacefully, doesn't look like there's any chance of that happening. Taiwan's going to defend themselves, and we still get. I mean, all these companies, Apple, they still get huge. The chips that Taiwan Semiconductor makes, the world can't run without those. Okay, the automobile sector will get crushed if we lose that. I mean, they get like more than 30% of their chips from Taiwan Semiconductor. And yes, Intel and some others are building these confabs here in the US. It takes 2 years to build those things. We are nowhere near a point where we can be self-sustained. And so, in terms of the most important chips that we need for the auto industry, for smartphones, et cetera. And so, right. This is if it happens, and there are some people, some really smart people. Kyle Bass thinks it's going to happen much sooner than later. I go back and forth. I was like, how could they possibly do this? But at the same time, they're going to lose a lot of leverage once we, 3 years from now, when we got these confabs up and running, and we don't need those chips as much. They're going to lose a lot of leverage, and people aren't going to be supporting them. Many other countries will not be supporting them at all, and they where if they did it now, they would have no choice but to support them because they need those chips. So It would be a big, big problem because we just don't have the capacity to make them outside of Taiwan to the degree the world needs them.
So with that in mind, let's go over two stocks, Intel and then LMT.
Okay. Well, just so you know, this was Tesla I had up there. Remember how I said those stocks are overbought? Well, Tesla's another one that's getting overbought. Not wildly overbought, but overbought. Let's go Intel. Intel, they're just having all sorts of problems. Now, okay, now it's funny. Their news was so bad. Let me get rid of some of these lines here so it doesn't chart isn't quite so. See, but let's take up here. Boom. Okay. Now here they reported their earnings right here, right? Disaster, right? Stock got crushed. But no, well, of course it's bounced back, but it didn't go back down and retest the lows down near 25. This stock is building a very nice base. And again, it's something I've said in the past. And I've been urging people, for several months, since the summer, and the stock has come down. It's like, buy this stock a little bit every month. I'm not saying load up and have your portfolio 20% in Intel. What I'm saying is that buy a little bit each month. Just buy it. Boom, boom, boom. They are having their problems, but their CEO is a good one. He's having a tougher time than I thought he would have turned this thing around. But again, the stock has bottomed. Everybody thinks, oh my God, Intel, they reported earnings, the stock got killed again. It's making new, well, actually, it's not making new lows. It's made a nice double bottom. Okay. And we remember back during the crisis, companies were too big to fail. Well, Intel is too big or too important not to succeed for all the reasons I just talked about. They're building a new Advanced Micro Devices is a great company, really well run. They're not big enough. They do not have the capacity to build the things the way Intel does. And Intel's, again, they're this new plant and confab in Ohio. It has to succeed. The government has to make sure it succeeds. They'll give them whatever contracts they need. Intel, as what used to be one of the most important tech companies in the world, it's no longer that way. It's still important. They have to succeed. They may not go reach their old heights. They may not be the next, go back to being like Microsoft did, went from being a great company to a mediocre company back to a great company. It may not make it back to a great company, but it's going to succeed. And it's not cheap. It's not expensive. Even after the reported earnings, let's just pull it up here. You can see on this thing here. Whoops. Oh, well, it's because of earnings. But their PE ratio at 38. You got a 5% dividend yield. We got to be careful. They may have to cut that dividend. But the point is, you're not backing up the truck. Sometimes you see, this stock it's such a great company. The stock got absolutely creamed. You got to back up the truck here. I'm not saying that. But and again, if you want to position and you want to make it 5% of your point, 3%, whatever, but say, hey, I'm going to put in X amount of dollars. I'm going to divide that money. Let's see how many, maybe $500. Okay. Or say, I'm going to put $1,200 into it. That's what I want to put in. Perfect. Every month, put in $100. Every month for the next year. All right. It's going to go. The stock's going to go all over the place. But like I said, it's not. Listening to the news, you feel like the stock must have gotten crushed over the last several months. It's not. It's actually up. And let's go back here. Okay. Now, here's a chart. I'm going to zoom this in. Okay, again, let's get rid of some of these lines. This is totally on long term. I'm not talking short term. Okay, but look at this thing. It made a double top high, and it's just gotten crushed. Double tops and double bottoms are very, very important. But look at this. Okay, it's making a very nice base here. Okay, this is actually a slightly higher high. I'm sorry, take it back. A slightly higher low. And okay, so let's zoom in on it again, especially for you people are both. If I'm wrong and the market doesn't go down, see how this is a higher low? First higher low we've seen since God was a child. Okay. And let's go here. See how close it is to making a higher high? So we made a higher low, a lower high, didn't make a higher low, didn't make a higher high, but only dipped slightly. Now we're back up and bouncing against it. If you can break above that and follow that higher low with a higher high, that's going to be bullish. And if it can break above its 200-day moving average, see how it got See how it's been. It couldn't break above it for months. Back here, got slightly above it. Remember, whenever you break above a resistance level or below a support level, it has to be a meaningful one. You get head fakes all the time. So here we got a very slight one. It turned out to be a head fake. Here, even more slight one, head fake. We can see how that 200-day moving average, when it gets up to here, assuming it does, I'll probably want to make some short-term negative bets because it's by then it'll probably be overbought, and assuming it gets there. But if it can break, especially you get the double thing. I buy some here with a breakout above here, above that level, and then once we get confirmed break, I'll buy more. But again, if you're buying it along, you can, if you have that $1,200, you buy $100 every month, but you can also poke in here and there if the stock really looks like it's breaking out, because then we'd also be looking at. I guess my point is everybody is bearish on this stock, and that gets me. When everybody's so bearish, now again, you'd have to get way up here. But if you go, so here's going to be bullish, here's going to be bullish. If you break above the 200-day and above its trend line. Now again, if it may not happen until later in the year, or maybe again, if you're bearish on the market. But this stock is trading much better than I mean, this is the stock bottomed in October, and it's just I'm sorry, in September, after a really a much longer decline than most other stocks. So I'm more constructive on Intel than a lot of other people are on a long-term basis. Short-term, you got to be careful. Just while we're talking here, and I mentioned those indices. The indices were overbought, and then I just showed how Tesla is overbought. Again, not crazy overbought, but definitely overbought. And here is Apple, same thing. See the RSI chart getting overbought there. Okay. Yes, there's no question. On a technical basis, the stock looks good because I'm going to draw it here, but you see the trend line. I got above the trend line. You see 200-day moving average was tough resistance. Well, got above it here, even after they reported earnings. It's funny though. Again, they reported negative earnings. The stock's up. It's their first earnings miss since 2016. The stock's up. Again, these as I said earlier, according I'm quoting Bloomberg. So far, the guidance for the first quarter is the worst quarterly guidance we've had since 2016, and earnings estimates have been coming down all month. And people keep trying to say it hasn't been a horrible month, and well, maybe it has been horrible. It's not been good. There's no way around it. A lot fewer. You have less than 70% of. I mean, everybody lowers their expectations enough so that they can beat them, right? Well, they're not doing that this time. You have way less than 70%. Usually, you get about 78, 79% of companies beat expectations. We're below 70%, and we still have some more companies to report. Guidance has not been good. Earnings estimates are coming down. It feels like it must be much better because stocks like Microsoft opened down, went up, and Apple. But again, the market has been rallying. Again, we did get positive news because there's no question that Powell was more dovish than anybody expected. People thought he'd throw some cold water in the market, and he didn't. So there's no question that that's positive. But everything else has been negative. And the earnings reports, earnings guidance has not been good. I mean, you can say, well, everybody was expecting, we're talking about, yes, they were expecting it to be really horrible. It hasn't been horrible. So they're looking past it. But the thing is, yeah, they were talking really bearish, but they weren't acting bearish because they weren't, they hadn't lowered their estimates. Number one. Number two, you can't say that people were acting bearish when the stock market was trading at 18 times earnings when earnings season started. Now it's trading at more than 19 times earnings. If the market had been trading at 15 times earnings, I would say, you're right. If these earnings turn out to be not so bad, the market's going to do fine. But what has happened? We've had the new money has come running. You got the fear of missing out, FOMO, fear of missing out. Institutional investors, no matter what you think about the market, I've been saying this for years, many years. The money comes in. If the market's going higher at the beginning of the year, they could think the world's coming to an end by March. They're still going to be buying in January. Why? Because they know they might be wrong about their concerns about the world coming to an end in March. And they have, if the market's moving up at the beginning of the year, they have to be in the market. And they get a lot of new money in. There's new money comes in because of 401k things, all sorts of things. There's new money comes in. They can sit on it like they did last year, or they can put it to work. Usually they put it to work. That's why Januaries are usually up. This time it's been particularly strong because they've had to chase it no matter what they think. Because why? Because they can't, because if they fall behind in January in terms of performance versus their bogey, which for many of them is the S&P 500, they fall behind, they spend the rest of the year trying to play catch up. And that is very, very difficult to do. They cannot do it. Once you get past the first month, which now we've done, then you can get, first of all, you don't have a lot of new money coming in. And now you're just pushing things around and trying to get to the right stocks. Now you can't get, money keeps coming in, don't get me wrong, just not to the same extent. So that's part of the rally. Then there were some short squeezes because remember how bearish people were at the end of last year, at the end of December. So a lot of shorts, they got squeezed. And they also have this gamma, this positive gamma issue where all these market makers who, they, they make the markets, and especially, we started JP Morgan talking at the middle of the week saying that the individual investor is back into the options market to a bigger degree than they were before the pandemic. And or even the second half of the pandemic, the highest ever, I guess is my point. And what happens is the market makers, if they sell those call options, people are buying calls, they sell the call options, okay? And so what do they have to do? They have to turn around and buy the stock, because they have to hedge themselves. They're in the business. They're not in the business of betting against you when you buy a call or betting against you when you buy a put. They just want to collect the commission. Most trades nowadays are free. They're not in the options market. You still pay a commission in the options market. They're just there to commit. That's their job. Their job is not to bet against you. Okay. And so the thing is, Tesla cut their prices by 20% and the stock went up 90%. Say what? What? I mean, I can understand why, Elon Musk and he's the Midas touch and all these great things, but you can give me all the arguments in the world why the stock should have rallied after that news, and I can understand. But 90%, no. It was this. Tesla became by far the biggest traded stock, and these market makers come in. And again, I'm not going to take forever to spend, but you can look it up in positive gamma. They have to go out and cover, and then it just feeds on itself as the market goes up. It's kind of like the opposite of forced selling; it's forced buying, and because they have to hedge their position. They're not going to just sell you the put the call in Tesla and just sit there. Because they when the option expires, they're going to owe the stock. They have to have the stock, right? And they don't have to pay up 50% for the stock. They've got to buy it as soon as it comes in. And when people are buying calls, it goes higher. Well, guess what? At some point, the thing reverses, and then people start first of all start unraveling, start selling those calls, and so those market makers have to turn around and sell the stock. And then some of those people say, not only am I going to sell my calls, I'm going to buy puts. And so they're going to sell more negative gamma. So it's this whole thing that could reverse it at any time. And I worry that when it does, it could be really, really bad because from my understanding, you have a lot of people who are making a lot of money writing, selling puts that are well out of the money. Now, in those cases, they're not hedging them immediately because the market's going up. And the problem is when the market rolls over and suddenly they've made so much money just collecting they haven't hedged it, and they're just collecting the commissions all month long. And they've been cha-ching, cha-ching, cha-ching. But when it rolls back over and they're late to making their hedges, things are going to get ugly very quickly. So this rally here, you just can't, but just because the Fed is going to pause, or the Fed might cut rates. Rates are still double where they were this time last year. Double, okay? And if they come down more, they're still not going to zero, and we're not getting QE. And people are getting laid off left and right, and that's going to. We're starting to see that spill over in other areas of the economy rather than just tech and finance. So we just got to use common sense a little bit here after a big rally like this. Even if you think I'm all wet, even if you think my concerns are a bunch of baloney, again, you're looking at things like Apple being as overbought. Again, it's not crazy, but seeing these big moves here, it just tells you when you got Tesla and the S&P and the Russell and the transportation index and Alibaba. I mean, one of my best calls last week. I write a newsletter in the Maley Report, theMaleyReport.com. That's Alibaba last week, and I said, This thing is, I don't care how bullish you might be. I mean, I love this. I thought this news is very bullish with China reopening and much fewer restrictions. But I said the stock is ridiculously overbought. Again, look at this RSI chart. Look how overbought I got. I said this last weekend. Sure enough, the stock was down 10% this week. People who read the Maley report and bought puts did very, very, very well. So, and I think we're running into the same situation here. Even if you think, Alibaba is going a lot higher, it's not going to go in a straight line. And again, we try to be educational and talk about things. Well, things are overbought. Here was Alibaba was a little bit easier to call. But these are the things we talk about in the chat room. But here, I want to get rid of this. Get rid of this. Okay. Now, I'm going to get rid of all these moving averages. But you can see how it got all overbought at the same time it was testing its old highs. I say its most recent high. So it's like when it's going up, it's kind of make a higher high here. It has nothing but lower highs and lower lows all the way down, including here. Can it make a higher high finally? It might be able to, but I didn't think it could on this attempt because it was not only is it getting overbought, but it's getting overbought when it was getting up, testing a tough resistance level. When you get tough resistance level plus an overbought condition, it usually pulls back, and it may be a quick turnaround, and you finally do break that key resistance level. And the same thing's on the other way when the stock gets really oversold like this was, see, and it was, if something is very oversold and is testing a key support level, it tends to bounce at least near term. Again, something that we like to teach people in the chat room. So it's an ongoing process. We're constantly talking about all these different aspects of the marketplace, whether it be technical analysis, just experience of things I've seen over the years. And one of the things I always talk about, how the market always seems to rally a little bit around long weekends. It's not a perfect indicator, but even more so around Memorial Day weekend. And I can guarantee you, I have absolutely no explanation why the market tends to rally on the Friday before Memorial Day and the Monday and the Tuesday afterwards. I have no idea why, but it happens most of the time. It doesn't skyrocket by 10%, so people are making millions of dollars. But if you want to be long on those, you want to buy a few. When we come around the next Memorial Day, buy a few calls on some index calls. You'll probably do well. Nothing's perfect. No trend is perfect, and it hasn't been Memorial Day, but it usually is. It's the funniest thing.
Right, Matt. So the credit card debt in the U.S. pretty much is like at an all-time high.
Yeah, just got the newest report out on Friday, and it just hit another new high. $1 trillion.
And delinquency rates are higher. I mean, similar for auto loans.
Exactly, going up for auto loans, et cetera. Yeah.
Right. So then, where is the strong economy then?
Yeah, everybody keeps talking about how the consumer is in good shape. Now, I do. We got to look at everything, and we do know that American Express, Visa, and MasterCard all reported good earnings last week or within the last week. I think Visa, MasterCard were last week. I think American Express might have been the week before. But anyway, it's very recently they reported good numbers. But we know that Capital One Financial reported very poor earnings. Discovery reported very poor earnings, talking about how the consumer has really gotten weak. Apple, their consumer businesses stunk. And iPhones, iPads, PCs. They're not PCs, but PCs all around the business, around the street, very weak. Auto sales starting to weaken. Union Pacific, the big railroad company, they talked about how the consumer is weakening. And let's pull my thing here. Sorry. Let's see if I can punch it out for you here. If I can find it. It's a long. I can never remember it off the top of my head, but the savings rate, here it is. Here is the savings, U.S. savings rate. The consumers in great shape. But the reason why they're still buying is, like you said, Rodrigo, because they're just buying more on their credit card. Second. Okay. Here is the savings rate. Okay, here we go. Okay, so U.S. personal savings rate as a percent of disposable income. Great. Okay, look at that. it's down at near all-time low levels. Okay, down near all-time low levels. See, it got way up because everybody was worried about the pandemic, right? But look at this. People don't have money. That's why they have to dip into that's why they have to spend money on the credit cards. And guess what? It's great that food prices aren't coming down. Okay, they've stopped going up. That's great. They talk about CPI, year over year CPI. So it's not going up faster than it was last year, but it's not going down either. I mean, my son has got a new apartment. He's paying rent. That rent's not going back down. I mean, he's paying what he's paying. He's in his 20s, and he's doing well. It's fine when it took but it's the point is that rent's not going back down. Okay, they talk about rents overall, maybe go down a little bit. Okay, you're still paying the same. You're paying higher for gas than you were last year. Paying higher to heat your home than you were last year. And unless those prices really come down in a big way, which it doesn't look like going to because of Ukrainian war, but food prices haven't come down at all. Okay, even though CPI will stabilize and even start to come down, the prices are still going to be high, I guess is my point. And let's talk about something I want to talk about right here. Look at the everybody talk about how inflation is coming down in a big way. Okay, that's fine. Here is the CRB commodity index. Okay. Oops. Okay. Here is the CRB commodity index. Everybody's saying, great, we don't have to worry about it. We don't have to worry about inflation anymore. It's coming. Well, yeah, it's no question it's come down. And as I said way back in June, May and June of last year, I said, of course it's going to come down. But is it really going to come down to the level that everybody thinks it's going to come down? Because this is not a demand-driven inflation. It is supply-driven because of the war in Ukraine and the supply chain issues, which boy, you want to talk about supply chain issues. My God, if China moves into Taiwan, it'll give a whole new meaning to the term supply chain problems. But look at this. This is, we saw the big inflation, right? Especially 2022, that topped out here. Oh, it's been coming down ever since. Actually, no, it hasn't. It stopped going down in September. Okay, and even there, it's really stopped going down in July, but it popped back up. September, it's flat. Now we're starting to drift a little bit, we're going flat. It's basing, okay? Copper. They call it Dr. Copper. Why do they call it Dr. Copper? Because they say it has a PhD in economics, because it goes, if you build anything, copper's got to be involved. You build a building, you build a factory, copper goes into, it goes into semiconductor, whatever you name it. Copper's important, okay? Okay, look how much copper's up. I'm going to do it here one more time. Same thing with this is just going to be closing prices. Okay, now it's dipped a little bit lately. Okay, well, inflation, inflation really, again, copper bottomed in July, all right? Is inflation really going to get down to the targets that they're talking about? Inflation is still is up. I'm sorry, copper's up 25% since July. Okay, corn. There are all sorts of different commodities. We can go on and on and on. I'll show you two more. It's corn. See what corn has done. See how corn has gone up. And again, it's held steady after its big bounce. And let's look at lumber. GP. Lumber, which of course goes to the building houses and et cetera, et cetera. And you can see, again, that might not seem like a huge bounce when you look at the chart, but when you go to the videotape and then you look at the percentage move, it's 48% rally, big rally. Okay, so inflation is if you look at the commodity markets, it's telling us that inflation may not be. It's going to be very difficult for inflation to fall as much as people are anticipating. It's going to be really interesting to see what Mr. Powell has to say this week at his. It is an interview that he's doing, and I don't know if it's Tuesday morning or Tuesday afternoon. I'm guessing it's in the afternoon. Early afternoon would be my guess. But is he going to change any of this? Maybe not. Maybe he'll continue to be quite quite dovish and talk about that there's a chance we cut interest rates later in the year. But if you really listen to what he said, it wasn't. I didn't think it was dovish. It was definitely more dovish than I expected. Don't get me wrong. But it wasn't maybe. I mean, he just said, yeah, if inflation comes down in a big way, yeah, we'll cut interest rates. But the problem is, if inflation comes down in a really big way, it'll have to be because demand falls through the floor. And if that happens, earnings are going to fall through the floor, and the stock market, then you have stagflation. Okay, well, I guess we would have stagflation, but the point is, if earnings, I'm sorry, if inflation does fall out of bed, and they feel they have to cut rates, it'll happen after the economy slows a lot more than it already has. Before earnings drop more than they already have, and that will cause the stock market to drop a lot more than it has, because like I said, they always react late. They never react until the stock market has become cheap, and we're a long way from becoming cheap. And not only we just at 14 times, I'm sorry, 19 overnight, well over 19 times earnings. In other words, a P/E ratio of well over 19. We have price to sales of 2.5, almost 2.5 now, 2.4 or higher, the price to sales ratio. And you can't fake sales. I mean, you can fiddle around with your earnings and put certain adjustments in there, but your sales are your sales. And 2.4, 2.3, anything like that. We did get up to 3 times sales at the peak a little over a year ago. That was way more overvalued than any time in history, way more. The level we're seeing now is not the level you see at market bottoms. It's the level you see at market tops. In fact, some market tops don't even get as expensive as this one is. And again, you can't fake sales. Your sales are your sales. Unless you're absolutely lying, then your people are going to jail. You can, again, your earnings, you can, certain charge-offs and certain things, you can make them look better. Sales are your sales. They are what they are. And you can't play with them you can't adjust them. They are what they are. And this market is having a tough time. Now we can understand why the market can handle a little bit higher, but not this much higher. Would be my way. So again, I just think we have a lot of volatility to play with, and these things I was talking about in terms of what's going on with the in the options market with this positive gamma, and then we have the flows, fun fear of missing out, short squeezes, etc. Is causing people. Kathy Wood, I'm usually a defender, but boy, taking a victory lap. Are you kidding me? She took a victory lap last week. I mean, it's great that her fund's having had a great month in January, but she's still down over 70% from the highs. A little early to be taking a victory lap, in my opinion. But maybe she's right. She's a smart person, very hardworking person, and a very good money manager. I just think that she's gonna. And I just don't think she realizes how much the impact of the excess liquidity that we saw to battle the pandemic, it had on her stocks, and now that now that we don't have that excess liquidity, and we're not going to go back to that. That's the thing, is that people are thinking we're going to go back to what we had in 2021. It's not going to happen because we're not going to go back to 22 times earnings, because we're not going to have, even if they lower interest rates, they're not going down to 0, and we're not going to have even if they stop doing QT, they're not going to start QE unless something breaks. If something breaks, they'll only start QE after that thing's broken, and if something breaks, the stock market's going to go boom. And again, so in other words, they won't do QE again until the market's a lot lower. And the same thing I believe with cutting rates. That's what history tells us. We have to look at history. This is very, very important. But like I said, if everything that was going on right now was happening with the S&P trading at 15 times earnings, I'd be singing a much different tune, especially if it was 14 or 13 times earnings. But it's not, and it's still expensive, and you can't, this thing about margin compression and margin expansion, not margin, I'm sorry, multiple expansion and multiple compression. That's a bunch of baloney. Multiple expansion is not a reason a stock rallies. Multiple expansion is not a reason a market rallies. It just moves higher because of something, some artificial reason. And then all it really is, the market is we're getting multiple expansion. All they're saying is that I think the stock can get more expensive. That's what they're saying. I think if a stock is trading as an expensive stock, if stock is expensive. Now, obviously, Apple can trade at a premium to the market multiple. higher PE ratio than the overall market because of their just free cash flow. It's a great company. But when there's a difference between a great company and a great stock. When it gets too expensive, it has to come back down a little bit. But right now it's back to somewhat expensive levels based on history, and you just can't keep going back. And people say, well, this stock can keep going higher because the multiple is going to expand. It's like, fine. But what you're saying is, what that analyst is really saying is that I think the stock can go higher because it can get more expensive. That's all they're saying, right? And I don't think that can happen because I don't think interest rates are going to fall as much as people say. We're not going to have QE. We've only had these ridiculous things. What happened in the late 1990s, it was the same thing as what happened in 2020 and 2021. Flooded the system with liquidity back in the late 1990s. They did it behind the scenes because Y2K, which was a problem that was fixed because of all that liquidity. But in 2000, the double zeros worked. Everything was the computers. The global computers were fine. They pulled the liquidity, and the stock market went. Well, they pulled the liquidity this time, and the market's going down. We do not, just like then, we do not need a deep recession. We don't need a recession. To knock down the market. We have to wait for the market. So much the Fed is fighting inflation, yes, but they're also trying to get the markets to trade on their own again. I mean, they've been trading on steroids for 12, 14 years, okay? And once they get to trade on their own, we're going to trade to 15 to 16 times earnings, maybe a little bit more than 16, but when and again, interest rates aren't at 20%, so then you don't have to worry about going to 14 or 12. But I mean, it can get that low for a while. But markets trade between 15 and 16 times earnings. That's just history. And when you get all this, when you give the market steroids, which they had to do, and they had to keep it on steroids because the financial system was so fragile, they didn't go higher. And they did it in late 1990s because the Y2K was going to disrupt the entire computer system and the whole financial system. So they had to fix that. They had to keep liquidity going. And they had it for several years. Once it pulled it away, the markets fell back in the line with what they should have been doing. That's what we're in the process now. Because they got so expensive, it's going to take more than 1 year to do it. Paul Singer, who was a billionaire hedge fund manager, said the same thing last week. I've been saying I'm not saying he stole my idea at all. I'm just saying it's something I've been saying for a long time. He said the same thing. Jim Chanos, another billionaire hedge fund manager, said what I've been saying for a long time about how the market. He said markets don't bottom until they get to somewhere between 9 to 14 times earnings. That's just. And that's something I've said a bunch of times here today, and I've said in the past. Anyway, I don't want to start rambling on here too much. We've been going on for almost 2 hours now, but maybe we can, I don't know, Rodrigo, if you want to try to look at one or two more stocks or whatever, and then we can wrap things up. But just my overall point is I don't want to sound overly bearish. I just think that we have to look at the markets realistically. And this rally here at the beginning of this year is when you look at, it's on the technical side of things, it's looking good, breaking some key resistance levels. But it is getting overbought near term. But more importantly, we are in a process of normalizing, not just normalizing interest rates, but normalizing stock prices back to valuations levels where they should be. That's going to processes. I think it's going to take at least 2 years to work through. And we're going to have a lot more volatility, which is going to be great for traders, active traders who want to be able to take advantage. Like I said, last year was a horrible year for most investors. It was a very good year for us.
Right. So we have Pinterest. They have earnings on Monday.
Okay. Hold on a second here. Let's get this thing here. What am I doing here? Sorry. What happened here? There we go. Okay. Okay. Now, here's a stock. It's interesting because, let me just one thing here. Okay. Yeah, 45 times. And it's It's not a cheap stock. Seen a nice rally. Let me just pull it up here again. Again, we'll have to see how things. It's so hard to get get something right when they report earnings unless you have some sort of inside information, and you don't want trade off inside information because eventually somebody's going to catch you and you don't want, and you're going to get in big trouble. So anyway, but you see how this stock is seeing it's looked good here. It was trading in this kind of sideways range for a while, but really kind of upward sloping, slightly upward sloping. And we made a nice, but you see how it's overbought here. It's not major league overbought, but it turned back down yesterday. The thing is, anything can happen. I just want to look at it on a week. Yeah, so it's again, it's not overbought on its weekly chart, but it's starting to get there. But my point is that what you want to look at when you're trading stock, if you want to trade earnings, is where is the stock technically? If it's a neutral stock, it's anybody's guess. And then you can use certain things. Certain companies tend to beat, and so tend to beat or tend to rally after they report, or tend to sell off after they report, et cetera. You can use some of the historical stuff. But what I like to use is again, this technical analysis. It tells you something, because if a stock is overbought, if they miss, its stock can get it hard, okay? Because it's extended anyway. It's pricing in good news. When it's that. So if it's overbought, and if it's overbought and it gets good news, again, it's already pricing in good news. So it better be really good news if it's going to go a lot higher. So I guess my point is when a stock's overbought, the upside potential, if they report good earnings, is not as good is not as big as the downside potential if they report poor earnings. The opposite is true is obviously when the stock is oversold. Stock is really oversold. The downside potential is not going to be very big if they report poor earnings because it's already pricing that in. But if they surprise and it's good earnings, they got much more upside potential. In this situation, we got a stock that's coming off an overbought position, so it's probably it's vulnerable. I can't promise you it's going to be a bad one. Therefore, the stock has to go down. I just don't know. But my real point is that if you want to play it, it's one where the downside potential is bigger than the upside potential. I guess is the best I can put it.
Right. Okay. And then we have Forever with ENPH.
Oh yeah, we talked about that last week. It's in the chat room. Oops. Okay. Now, so here's the stock. Well, the one thing that's a concern, of course, is that it made a lower low. Okay, kind of like a double top, but it could slightly higher, a lower low, then rallied up, much lower high, and then another lower low. What's it going to do now? Is it going to do? Can it break up here? The one thing though is that it's as you said, you can see how it's coming off of very oversold. But when I was asked about it earlier last week, I was bullish on it because it was down here and the stock was oversold. It's worked off a little bit of that oversold condition, but not a lot. I'm just going to go back a little bit. Okay. Yeah, it's just kind of that. I like that upward kind of trend channel it's been in for a while, right? And let me know. Oh yeah, we're sitting here. Okay. No, it's not. I mean, I bow down here when I got oversold on this weekly. That was a great buying opportunity. It doesn't have to get that over. It's, it's kind of neutral there. But look at here. One thing you want to look at. This is a weekly chart. See how the 100 week. Oops. See how the 100 week moving average has provided really good support. It did dip below it though. We got a little bit of work. I mean, on 3 different weeks in the last year or so, got right down to it. But it seems to me like it's going to hold that thing again. I'm bullish on the energy sector overall. I must admit, although I'm a little worried near term, but the big thing is going to be what happens with with this new news. That's not new news. We've known this is going to be happening for a while, but we finally get these things against Russia are going to go into or start going into place on Monday, or tomorrow. So that'll be interesting to see. But again, I like just the overall fact that it has a nice upward trajectory. And if it can bounce off here, this looks like a decent entry point. I liked it better a couple of days ago when it was down, but we do have to be a little bit careful on with the price of oil having come down a little bit.
Right, Matt. So thanks a lot here. I'm going to be showing the folks here the live room for everybody that did sign up. And if anybody has questions as well. But Matt, for closing remarks here, what will you be looking at in the chat room this week, and why the folks should join here the live room trading with you the whole day?
Well, I just think the biggest thing, again, like I said, I've said it a couple of times, but just trading alone is such a tough thing to do. And you listen to the financial news, and they're again, the people they have on tend to be paid to be bullish, and so that's okay. But even in a bull market, it's like, oh, okay, but you want to. People are going to tell you, give you the real thing, and so that's number one. But number two, again, is just that you really want the biggest and the best, the most successful traders in the world are not trading alone. They never trade alone. They're trading, getting help from people all day, every day, and you should do the same. And that's one of the things that's worked really well in our chat room. And as for the things we'll be looking at this week, of course, we get the Fed chairman speaks on Tuesday, and we get some other earnings coming up. The key thing, though, I'm going to be looking at some of this technical analysis. We've become overbought. And the three big major averages, I showed you Apple, I showed you Tesla, the transportation index, et cetera. This market should pull back a little bit. It may not happen until after Tuesday, but I think we're getting ripe for one. And we're going to look for some signals for that kind of movement, and see if we can't take advantage of some of these stocks that have run up. One of the ones we made some nice money last week was buying puts on Carvana. Stock ran up to $18, $19. That's ridiculous. And so Tesla, this is when we're going to be looking at some puts at there at some point, maybe not till Tuesday or Wednesday. But it's just getting quite extended. I told you on the technical side of things. And has the news really been that good to cause a 90% rally? I don't think so. So these are the types of things we'll be watching Apple very, very closely. Can they sustain their gains from last week after that really quite mediocre earnings report? So a lot of things to watch for. The market has rallied mostly because the big cap stocks have rallied. Most of them have not reported great earnings. Meta didn't beat expectations, but that stock was beaten up and much cheaper. Most of them have not reported particularly good earnings. And so if they turn down, the rest of the market's going to go with it. And we're going to want to take advantage of that, even if the market has already bottomed and going a lot higher. I'm cautious on that side of things, but I think the market can, believe me, last year when the market was going down, we made money on both sides. And sometimes both sides, like in the XLE, we made a couple of trades where we made multiple hundreds of percent on the XLE, which is the energy stock ETF, both puts and calls. And so I think we're going to see a lot more of that this year. And again, we now have the tools. We never had those. 10 years ago, you didn't have weekly options on the big cap names. You didn't have daily options on the indexes. You didn't have inverse ETFs. You didn't have what do you call it? Leveraged ETFs. We have the tools that only the institutions had 10 years ago, and even 5 years ago they were out there, but they weren't as liquid as they are now. We have them now, and I think this is the time, a real good time for the individual investor to trade more actively, something that was much harder to do in the past. But thanks a lot for joining us today. Good luck with everything. It's going to be another great year, a great year for trading, no question in my mind. And I hope those who join us, I hope others will consider it. And good luck with everything. And Rodrigo, thank you. We'll talk to you real soon, buddy.
All right, I'll see you in the chat room there. Matt, there we go. Thanks a lot for being here, Mr. Matt. And
Thanks,
yep, no problem, man. So folks, for everybody that did join, I'm going to give you a quick review here of the live room. If you have questions, feel free to put them in the chat. So this is where you want to be, right? In the blue chat room. It's open 24/7, basically. So there's two main ones here. The inner circle chat, where everybody is communicating, right? Including Matt Maley and the members right now. There's 46 people online right now. And if you go to Matt's important messages, this is where you're going to get entries, exits, all that sort of stuff, market commentary. The meeting that's on Tuesday, that's at 11:30, and you're gonna get an invite on your email, right? And the chat room is open pretty much all day, but Matt is there 8 a.m. till 5 p.m. If you do have a phone and internet, download the app Benzinga. And if you log in with your credentials, you're going to get push notifications as mobile alerts on your phone. So that's free. You just have to log in. And every time that Matt is posting an entry or an exit, you'll be able to pretty much catch that trade. So even if you do have that 9 to 5, even if you are, not in front of the computer the whole day, you can always do that, right? And if you are in front of a computer, well, you can always be in the live room here. There's a great conversation, a lot of great folks here. Everybody that's here is a real person. There's no bots, there's no fake accounts. These are all active users. Donald's in the house, James D. See Roland, what's going on, Roland? Signed up a few weeks ago. So yeah, I mean, it's a great conversation there, folks. And if anybody does have questions, I know some people were asking where is how to join the stuff. The link is in the chat. Yes, Matt Maley. So this meeting that we had today on Tuesday, it's only Matt, right? And that's going to be just for the chat members. If you have questions, if you want the recording on that, you can always just request it. As long as you're an inner circle member, you will have access to it. So the link is on the checkout, on the chat, folks. Thanks a lot for being here. If anybody has questions, the contact is there as well. So Deborah, good to see you. But basically, V Zynga. Okay, good question. Matt Maley closes his options trades after how many days? So these are not meant to be day trades. These have holding periods of, I would say, anywhere from 2 to 5 days, especially since the calls and puts that Matt is buying, these are short term, right? So we buy close to same day, as close as we can, because we're trading for the volatility, right? We're trying to catch the move, capture volatility in short. And we can do that pretty well with these calls and puts. So it's going to be always on the NASDAQ what Matt is trading. And he will give you something like this as an example. Let me log in. All right, so he bought a couple of puts on Rivian February 3rd. So you would have gotten this entry, right? Doesn't matter where you are on your phone, mobile alerts with the app. And then you would have gotten the sell alert as well, right? Where he sold them the day after for 100%. Where is it? There. And you would have gotten the other alert as well where he sold the rest for 180. So you would have gotten these alerts, basically everything you would get, everything that he will post in this room, Matt's important messages, you will get as a push notification. And so once you log in, just make sure, check your email for all the folks that did sign up. I do have to give a big shout out here. Mary, welcome to the family. Mary, just make sure to check your email, create the account. Everything, once you complete everything, it'll pretty much take you to the chat room. You pick your username. VG, yes, so it's 2 to 5 days, the holding periods. These are not meant to be day trades. Separate from that, you will get 6 email trade alerts per month from Matt, which are stocks. They're not option trades. They're swings, holding periods of 1 to 3 months. And that's something that you'll get by email. You can get those alerts by text if you want. MK, what's going on, MK? Good to see you here, man. Yes, I think you do get those as well, the push notifications, MK. But you can get text alerts for those. For the email trade alerts, you can get text, like SMS text alerts for free. Gabby, what level of investors would your platform cater for? So this would be for traders, for people that are trading options, basically. Right now, you can always ask Matt Maley about long-term holdings in the chat room. As you can see here, you can type, right? So you can ask questions to Matt. And a lot of people do ask questions about, certain stocks that they should hold for 5-10 years plus. And that's something totally fine that you can ask Matt. You can ask Matt like anything there in the chat room, right? So you can always pop in there. This is a cool feature. I don't know if you use it, but you can also private message people here, like another user, right? So if you do have, like, for example, Biking Chef, he's been there for a while. So you can, pretty much search and also have, different messages, private direct messages here with other folks, members, and things like that. So next, all right, Gabby, the next thing was on what platform brokerage are the trades performed? So you can use any brokerage that you want. Gabby, you can use E-Trade, Schwab, Interactive, Robinhood, Webull, whichever one, really. It's really up to you which one you like. You don't need a specific, because all you're doing with Matt is buying calls and buying puts. You're not selling puts. You're not selling calls. You're not doing spreads or condors. The most I've seen him do is a straddle, which is still trying to capture the volatility. So it's pretty much down to that, buying calls and buying puts. Invid have a good day too, brother. Well, I mean, I guess I'm not sure really. You got to check with the brokerage, Pyrus. I know they're all different. I don't know if they're more, which one's lenient and which one's not. But this is the most basic type of options trade that you can make. So it's meant for people that are new, right? Because you're not doing spreads, you're not doing condors, you're not doing all this complicated stuff. You're trading the volatility. Hashi says any day trading stocks only. Well, I mean, I guess, look, if you don't trade options, what you can do is that instead of buying the call or put that Matt is buying, you basically just buy the ETF, right? Let's say we're buying calls on the TQQQ, right? Well, buy the TQQQ. It's like $18, $20, something like that. So you can buy the actual, ETF stock pretty much. So, and if he's buying calls on the SQQQ, you can just buy the SQQQ, right? So you can do that if you don't want to trade the options. That's something that some of the folks do there. So quick recap, folks. We did go over, yes, Pyrus, since we launched it in late 2021. So I launched this chat room with Matt. And since we launched the chat room, I know that particular portfolio, right, is up well over 300%. And the 6 email trade alerts per month, that's like, I think it's like an average of 38% annual return. So again, those 6 email trade alerts per month, Hashi, are stocks. So it's like a swing. So you're holding it from 1 to 3 months. It's a short period of time that you hold this. Many times it'll, sometimes, like he was buying FAS, which is shorting financials, and he had a price target of like, not the price target, but basically he'll tell you, I think it's going to reach this price by this point. So many times it'll hit in 2 weeks, less than a month, but you're basically holding it for that particular price target. So it will tell you, this is where you should purchase it, and this is where you should sell it. So it gives you a price target, and those are swings for stocks, not options. The chat room is basically only options. So that's financial. I put the link there in the chat for you, no worries. So Pyrus, that kind of answers your question. And the recordings you just have to ask for the recordings. Basically, if you need the recording of the Tuesday session, which is at 11:30, just for the members here in the chat, they get like a Zoom invite. And so here in the Inner Circle chat, you can have this open and you can put up these sound alerts when the bells are yellow. So there will be like a pop sound if you do want to have it open. This is all you need to have open, really. Your brokerage to make the trade, and basically have everything here, right? Where you can see this directly, what he's doing, when he's buying, when he's selling. And you get the push notification. I get every single alert on my phone. I can't make every trade because I'm busy here, but I can tell you that if you would want to make every trade, and obviously, all you have to do is follow Matt. And there's also a lot of education in the Tuesday meeting, market discussions, what's happening in the current market, analyzing this with a chief market strategist. So you have a meeting for about 1 hour with a chief market strategist, Matt Maley, where you discuss not just the markets, but your trades, any adjustments, that sort of stuff. Yeah, Gabby, so if you're trading Forex, I know for sure that we've made some trades on the dollar with calls and puts on UUP, but that is one way that we do get some exposure into the currency world, if you know, if that's kind of what you're into. But I'm sure there's other I mean, I know there's a symbol for the yen, there's a symbol for the euro. I personally don't trade that stuff, but you know, if you're looking to do that, you can always trade through stocks, right? Through these ETFs that you can find. So, all right, I think that kind of covers Sunset. It's only annual or lifetime, right? Gabby, there's a bunch. You can all just Google search. You can probably find a few of them. So, all right, folks, I put the contact in the chat. Big shout out everybody for being here, participating, and attending this great session, this cash flow option strategy seminar with Matt Maley. If you have questions on the room or anything, the live room with Matt, or you know how you can get a hold of Matt basically to help him so he can help you, you know, with trades and things like that, reach out. The contact is in the chat. Hashi, you're welcome. Everybody have a happy Sunday. Enjoy. We'll see you tomorrow in the chat room, folks. Everybody, have a great day, y'all.